Interest rates are in the news day in and day out, but do you know what factors affect whether they rise or fall? Unfortunately, there's no simple answer because no single component determines where rates go. But let's dive a little deeper on a few of the primary factors. Inflation. Inflation occurs when the money supply used to purchase products exceeds the products available for purchase. The bigger the gap, the higher the inflation. Higher inflation will typically cause treasury yields and mortgage rates to rise as well. This occurs because investors demand higher rates as compensation for the decrease in the purchasing power of money they are paid over the course of the loan. Economic health. The overall economy also affects mortgage rates. When the gross domestic product, or GDP, and employment rise, it's a sign of a growing economy, so there is a greater demand for goods and services, including real estate. A growing economy creates competition from those wishing to borrow money. This demand causes interest rates to rise. The opposite is true in a slowing economy. Borrowing demand falls, causing interest rates to improve. Fed policy. The third factor is the Federal Reserve. When the Fed raises or lowers the federal funds rate, which is the rate lenders charge each other, it creates a ripple effect, resulting in higher or lower mortgage rates. Geopolitical factors. The global economy is tied together more closely today than ever before. Global economic factors and other world events can move interest rates in the United States. This can occur even with events that have no direct correlation to the U.S. economy. Government intervention. The U.S. government has the ability and may step in to help influence interest rate movement when necessary. This is primarily accomplished when the government directly purchases bonds and other securities for sale in the open market. In short, when the economy is strong and growing, and rates rise to make this investment vehicle more attractive to investors. When the economy is slow or sluggish, borrowers become choosier with how they spend their money, so rates fall to attract more consumers.